When we look back at the massive infrastructure projects of the past, like the laying of the early railroads, those investments usually aligned closely with a wave of widespread consumer excitement and everyday economic participation. We saw the same pattern repeat during the early oil rushes. Extracting physical commodities fueled corporate wealth, while simultaneously driving a massive boom in everyday Main Street growth. Today, the massive 2025 AI infrastructure build-out that we are witnessing is the exact modern equivalent of those sweeping industrial cycles. But the historical pattern has broken. Right now, a massive concentration of capital is flowing into infrastructure, while the everyday consumer is being financially pressured by inflation. This line chart shows that divergence in real time. The upward trajectory tracks the billions spent by tech giants, while the downward line tracks the shrinking budgets of everyday retail and food consumers. Understanding this exact split, the Great Divergence, is the only way to accurately read the modern corporate landscape. We can see the scale of this cycle in this scaling bar chart. Total cloud and AI infrastructure investment is projected to hit $600 billion by 2026. The specific metric driving this entire phase is capital expenditure, or CapEx. Notice Microsoft's enormous share of that total pool. In their third quarter alone, they recorded $34.9 billion in CapEx, driven entirely by a plan to double their massive data center network in just 2 years. Now stack Amazon's projected $125 billion on top of that, along with Meta's revised $72 billion spending limit. This is an industry-wide arms race. These numbers are not Wall Street speculation. They represent a frantic, physical scramble for incredibly scarce computing resources. In this revolution, the companies that fail to build physical plumbing right now will be entirely locked out of the future economy. Beneath the data centers, this entire $600 billion revolution is bottlenecked by a single foundational layer, physical silicon manufacturing. TSMC controls this critical choke point. They have capped their own 2025 capital expenditure between $40 and $42 billion. That money is aimed specifically at doubling an advanced packaging capability known as CoWoS, chip on wafer on substrate. And despite high geopolitical tensions and the looming threat of tariffs, equipment makers like ASML are still posting incredibly strong quarterly sales, clearing 7.5 billion euros. Physical manufacturing constraints at a few highly specialized foundries now set the strict speed limit for human innovation. Pivot away from that trillion-dollar tech boom to the ground-level economy, and you realize AI's benefits have not yet arrived for the average person. This demographic split chart mapping McDonald's earnings data lays it out clearly. Notice the severe drop in visits from low-income consumers, happening right alongside a double-digit percentage increase in traffic from the high-income bracket. This financial squeeze is so severe, it is even pulling down traditional luxury. LVMH reported a 2% drop in their fashion and leather goods division because middle-class tourists simply vanished. But contrast LVMH's drop with L'Oreal, which posted a 4.2% growth. We are looking at a classic lipstick effect. Shoppers are opting for smaller, affordable luxuries like high-end cosmetics instead of expensive handbags. Today, the middle-class consumer is effectively vanishing entirely. Brands are now fighting over two completely disconnected extremes of wealth. The hidden engine keeping both sides of this fractured economy stable is a fiercely resilient global banking system. Bank of America sits at the foundation, reporting $15.4 billion in net interest income and an $8.5 billion pure profit cushion. Now add JP Morgan Chase's $14.4 billion net profit. This proves the tech boom's capital pipelines are completely insulated from the consumer struggle. Unlimited capital at the top and fierce financial pressure at the bottom. This is the great divergence of 2025 and 2026. To survive 2026, a corporation must make a binary choice. They must either integrate into the massive AI infrastructure wave or retool their business to serve a fractured, exhausted consumer. There is no middle ground left. In 2025, the global economy is splitting. Tech giants are currently deploying over $600 billion toward artificial intelligence infrastructure, a capital commitment that rivals the annual GDP of many developed nations. Simultaneously, persistent inflation is forcing a quantifiable retreat in the retail and luxury sectors as household budgets tighten. This 3D data topology tracks 2025 capital flows. On the left, capital expenditure forms a vertical heat map representing the tech infrastructure surge. On the right, the global consumer budget forms a fracturing, sinking plane, reflecting extreme pressure on retail and luxury. The gap between these two sectors is widening as tech firms accelerate spending to secure AI market share, while traditional consumer brands are fighting for a shrinking portion of discretionary income. Evaluating the 2025 corporate landscape requires looking past top-line earnings. We have to isolate the structural forces driving this divergence to understand where the actual control of the market is shifting. Understanding the tech boom requires looking at the physical hardware. The current expansion is centered on hyper-modern facilities that require gigawatts of power and tens of billions in immediate capital investment. Microsoft's recent performance provides the baseline: $34.9 billion in third-quarter capital expenditure to fund AI facilities like their Fairwater data center. Based on their trajectory, Microsoft expects to double its total data center capacity within 24 months. Of this total capacity expansion, 80% is dedicated strictly to handling artificial intelligence workloads. Microsoft's $35 billion quarterly spend represents a pivot from software-based growth toward a model centered on heavy physical assets. This creates a capital-intensive baseline that the rest of the industry is now forced to match. This timeline charts capital expenditure for major cloud providers, heading toward a combined $600 billion by 2026. Amazon contributes a projected $125 billion in 2025. Meta raised its spending ceiling to between $70 and $72 billion for the coming year. Furthermore, Meta management informed investors to expect even steeper spending acceleration heading into 2026. This aggressive spending is a response to a documented shortage of AI resources. Alibaba has noted that current market capacities are operating at full utilization, leaving little room for new demand. The constraint for hyperscalers is no longer capital. The physical limits of global construction and power grids have become the primary ceiling on growth. Every dollar of that massive $600 billion infrastructure investment relies entirely on a highly specialized, physically constrained semiconductor supply chain. This 3D model shows chip-on-wafer-on-substrate, or CoWoS. The physical complexity of stacking and connecting these layers is the primary bottleneck for AI hardware production. To manage this pressure, TSMC capped its 2025 capital expenditure between $40 and $42 billion. A significant 70% of that budget is dedicated strictly to 2-nanometer fabrication. Although TSMC has doubled its CoWoS capacity, the volume of orders from hyperscalers continues to exceed the factory's physical output limits. Global AI expansion faces a rigid physical boundary. Subatomic manufacturing constraints dictate the maximum pace of growth, effectively capping what boardroom budgets can achieve. ASML, which builds the machines required for this manufacturing, serves as a barometer for the health of the entire supply chain. ASML's quarterly sales reached 7.5 billion euros, confirming that demand for high-end chipmaking hardware remains high. However, these sales figures are being weighed against rising geopolitical tensions and the prospect of new trade tariffs. Geopolitical restrictions represent a systemic threat to the infrastructure boom. If access to these specialized machines is restricted, no amount of additional capital can maintain the current pace of expansion. Outside the technology sector, the economy moves differently. The consumer base has effectively split into two distinct tiers. We see this trend in McDonald's earnings, which track the spending habits of millions of working-class households. Persistent inflation has caused a sharp decline in low-income spending, prioritizing essentials over dining out. Yet McDonald's noted double-digit growth from high-income households, choosing their menu over more expensive alternatives. This pressure is also visible in the luxury sector, testing affluent buyers. LVMH reported a 2% drop in its fashion and leather goods division, as tourists and high-end consumers scale back. This contraction is directly linked to a decrease in international travel spending, proving that even the top tier of the market is becoming more selective. However, consumers are still spending on smaller, premium items, the lipstick effect. While fashion sales slow, L'Oreal recorded 4.2% growth, indicating loyalty to beauty brands remains strong, even as consumers cut back elsewhere. For retail and consumer brands, the market is no longer a single entity. Survival now depends on which side of this income fracture a brand is positioned to serve. There is one sector that unifies these two diverging realities: the banking industry. Zooming out, the financial ledger acts as the foundation for the 2025 landscape. Bank of America recorded an $8.5 billion net profit, fueled by $15.4 billion in net interest income. JP Morgan Chase added a $14.4 billion net profit, demonstrating high systemic profitability. This institutional strength provides the capital for hyperscaler expansion, while simultaneously earning record interest from a pressured consumer market. Heading into 2026, companies face a binary choice: integrate into the AI infrastructure cycle or restructure to fit a fractured consumer base. In both scenarios, the financial sector remains the primary beneficiary.